When I take a look at a stock chart of a stock that I'm considering buying, I like to look at the chart in multiple perspectives to find any weaknesses in the stock. On a technical basis, very few other technical chartists do this. I call it triangulation. So what is triangulation of data in a qualitative research? Well, it's a method of validating the information collected through various other methods. And triangulation means using more than one method to collect data on the same topic. And this is a way of assuring the validity of research through the use of a variety of other methods to collect data on the same topic, which involves different types of samples as well as other methods of data collection. The purpose of triangulation is not necessarily to cross-validate, but rather to capture different dimensions of the same phenomenon. So it can either cross-validate or it can invalidate. What do I mean by this? Well, let's take a look. As an example, Marco recently asked me to do a video on precious metals, and I'll get to that as soon as possible. And when I do, I'm going to be looking at other perspectives, such as gold, silver, the dollar, and interest rates, since they're all interrelated. So if any of these other indications show something odd, I need to look into it further to find out whether or not that indication is a validation or an invalidation of the thesis. As another example, if I'm taking a look at an individual stock, I want to look at each and every of the oscillators. And if all of the oscillators line up, then you've minimized the risk of your investment. All right, let's go into another example. So I picked up this article from a week ago, but even though it's a few days old, it still will serve our purposes here. And basically, I'm going to show you a couple of things. The author of this article has pointed out this here, which is a rising wedge. And what happens is oftentimes they break down, as this did. It broke down at this point, down to here to that level. And then following the wedge is what's called a bear flag. You can see the bear flag here. So now, with that context, let me read from the article. And it reads, does anyone else see a giant bear flag pattern in the daily chart of the S&P 500? Maybe I'm the only one who sees a bearish signal instead of a bullish breakout. What I see post mini crash is the bearish rising wedge, as I showed you, which broke to the downside. And what followed the rising wedge was a bear flag. And as the name implies, bear flags are, well, bearish. They tend to break lower in a continuation of trend. The consensus of soothsayers seems to be that the trend is still bullish. I guess I'm the only one who sees lower highs since late January, something that does not strike me as evidence of a bullish trend, the definition of which is higher highs. And later in the article, it reads, if the tinfoil hat outlier, who is the author, who sees a big fat bear flag is correct, the next move will surprise to the downside. And then he sums up the article with this, the roulette wheel is still spinning, so place your bets. Well, he's going to place his bets on the roulette wheel based on this chart. Me? I'm not going to place a bet on the roulette wheel. I want to be the house. So let me show you how it's done. Okay, here are the 6-month chart on the spiders, and I've done the best I can to replicate the trend lines. And here is the bearish rising wedge here that broke down into now the bearish flag at this point here. So, as opposed to simply taking a look at this technical chart, which, by the way, the author did a good job here. I mean, this is valid in a general technical sense. However, for me, I'm going to validate that with my triangulation. Number one, I'm going to look at the daily oscillators. We move on down here into the MACD, and we can see the bottom at this point, and we have a good, strong, clear trend line moving up. We're above zero, And at this point here, we seem to be accelerating. In my opinion, that is a favorable condition. I'm not looking for any downtrend from here. It is possible, like at this point here and at this point here, that we might have some moments of consolidation before a continuation of the uptrend. That's what I see so far. And that is shown here in the histogram as well as in the price rate of change. Things are heading on up, as well as in the RSI. It's getting stronger and stronger from this point all the way up here, and also on the top side. Moving down here, stochastics look good, and the volume looks fine. And then, of course, the Williams also replicates what the other oscillators are showing. So to me, right now, I simply see a stock, or in this case, an indice that is improving. I don't see that this thing is going to break down. All right, let's go to my second indication, the weekly spiders. In my opinion, where most people fail is simply looking at one technical chart. So my first method was to take a look at those oscillators. That's where I believe that the heart and soul of a stock or an index is in those oscillators. But they don't look at that. And then oftentimes they won't go look at a different time frame. So here we have the 2-year weekly. And this is your downtrend from here down through there. So we've broken through this downtrend at this point here. The next stop is going to be at this level here, and then of course at the previous high. So those 2 points you're going to be looking at on a technical basis. In my opinion, I look at it this way. Here's a nice dish, and we're heading on up, and we're about to go through that first line of resistance, and I think possibly even to the next line here, which is the previous high. But going into the oscillators, clearly, in my opinion, we've hit bottom, we're above zero, the fast line has moved through the slow line, and we're going to continue on up in that direction there. Same thing shows in the histogram, as well as in the price rate of change. Relative strength moving on up. Stochastics clearly moving on up. Volume looks fine. And then the Williams also racing on its way up. So in my opinion, this invalidates the author's thesis that the stock or the index is going to break down. So now let's go to my third indication. And we're looking at the triple Q, which is essentially a proxy for the NASDAQ. And this is a 2-year weekly chart. And such as the 2-year weekly chart on the spiders, we have a nice dish, and we're heading on our way up. And in this regard, we're probably right near that historical high, if not already higher. Moving here into the MACD, you see that the bottom is here, and it's moved on up through the fast line, and it's even stronger than the S&P, being that we have a good elevation above the zero line there. And this is also shown in the histogram, heading on up. Price rate of change is a little bit muddled, but the relative strength, stochastic, volume is fine, and then the Williams all are on their way up. So back up here, the author's thesis is that, in his opinion, the S&P is going to break down, or there's a probability of it breaking down. In my opinion, the greatest probability is that the S&P, as well as the other indexes, are on their way up, perhaps to new highs. So I suggest, if you're going to take a look at a stock, an index, or whatever, you take a look at it and use other methods to validate your position. Don't just simply rest on one perspective. It will fail you. Look at multiple perspectives. So for today, that's ChewDog Charts. Thank you.